concepts in understanding human decision-making, business decision-making, governmental decision-making, and that is the concepts of time value of money and also the strategy of cost-benefit analysis. So let's jump right in. Now, whenever we're making decisions and we're making choices between options A, B, or C, oftentimes options A, B, and C have different costs. They have different relative benefits. And we're going to use costs and benefits here extremely broadly, meaning anything where there's expenditure of resources, that's going to be a cost, and anything where there is an increase in resources, that's going to be sort of considered a benefit. And you can think about just sort of generally any situation in which there are costs and benefits, and you can apply these concepts. But whenever we want to choose between options, we need to compare those options. And the thing about money and the thing about benefits and costs is that when we experience costs and benefits at different time periods, the fact that money has opportunity cost means that money has time value. This means that we have to consider time whenever we're comparing potential investments to each other, potential decisions to each other. And if we don't, then we're not getting the full picture of what's going on. And in many respects, we're not really able to kind of even estimate and compare. And really that's what's at stake here, is that if we're going to set out to compare decisions and hopefully come up with the best possible decision, then we need to be able to compare things. And time presents a complication in decision making, most often in financial decision making, because it represents something that needs to be considered. That is to say that investments which yield benefits into the future have costs. We need to take the in the future perspective into consideration to get a clearer and comparable understanding of potential decisions or choices. Suppose we have to choose between three options. Option A says you'll get $100 today. Option B says you'll get $105 1 year from now. And option C says you'll get $110 in 2 years. The problem, of course, is that I can't readily compare these three options. They are, as we often might say, apples and oranges. For example, I could take $100 today if it was given to me, and I could invest it. I could buy a stock or a bond, and it could yield to me a return. And so $100 today is not necessarily $100 1 year from now, and nor is $105 1 year from now equal to $105 today. And so what we want to do is we want to take these three options. We want to perform a calculation that makes these apples to apples comparisons and not merely apples to oranges comparisons. In essence, what we're going to do is we're going to consider the time value of money. In order to consider the time value of money when we have flows of money that are occurring into the future, we need to discount those back to the present. When we say discount, what we mean is that $105 1 year from now is not worth $105 to me today. The only thing worth $105 to me today is $105 today. $105 1 year from now misses that in that time, I could have taken those resources and I could have invested them. I could have done something with that money that would have yielded me potential benefit. And so that $105 1 year from now needs to be discounted back to the present in order for me to understand what $105 1 year from now is actually worth today. And so what we use is this concept called present value. And present value is simply the value today of money received in the future. And the calculation looks like this. Present value is equal to the future value, FV, divided by 1 plus R, where R is the discount rate, and then raised to the power of T, where T is the number of time periods. So if I was going to get $105 1 year from now, my present value calculation would look like this. $105 divided by 1 plus 0.05. Here we're going to assume a 5% discount rate. So 0.05 raised to the power of 1. Well, what we see is that $105 1 year from now, when we assume a 5% discount rate, is in fact equal to $100 today. So in terms of option A and option B, in present value terms, these are equivalent options. $100 today is equal to $100 today in present value terms. And again, assuming a 5% discount rate, we see that $105 1 year from now is equal to, in present value terms, $100 today. And then that third option, $110 in 2 years. Well, here we actually see that the present value of $110 in 2 years, assuming a 5% discount rate, is a little bit less than $100. So A and B yield for us the same in terms of present value, but in fact, that third option, $110 in 2 years, is just a little bit less than $100. Now, what you should see here is that we can see the present value calculations dependent upon, in many respects, the discount rate, the number of time periods that we're considering. And if both of those things increase, that is, we choose a higher discount rate, or we choose a larger number of time periods, that is to say, 10 years from now or 20 years from now, we can see that the present value declines. And so the higher the discount rate, the lower the present value, and the longer the time in the future the money will be received, the lower the present value. This is important because ultimately the discount rate is usually a choice. We choose the discount rate, and usually the choice of discount rate is based upon market interest rates at that time. Because ultimately what we want to compare is, well, what is $110 in 2 years? We want to compare that to $100 today, because we could take that $100, we could invest it and earn a return, the return being the interest rate. And so usually we base discount rates on interest rates such as the federal funds rate, or something like that. That way we get a relatively, in line with the economy view of what the present value of future, cash flows would be. Now, sometimes we have to make decisions which are more complicated than just amount of money into the future. It could be some costs in the future, it could be some benefits in the future, and they could be happening at different times. And again, because money has time value, this is something that we have to take into consideration. And so usually when we perform cost benefit analysis, this is what we have to do. Costs are experienced at a distinct time, benefits are experienced at distinct time periods. We have to consider those to get an accurate picture for a particular project. So consider a new HVAC system. The HVAC system is going to cost $100. However, in costs, we're going to save $35 per year. So the cost is the $100 of the HVAC system, and the benefits are the $35 per year. And so suppose we want to compare this particular HVAC system to another HVAC system. Well, let's first compute the present value of this HVAC system over a number of years. And we're going to ask the question, how long until the new HVAC system pays itself back? Right? This is often a cost benefit analysis metric. We want to know how quickly does a particular project pay itself back? And so that's what we're going to ask ourselves. So we're going to take what we learned previously about present value calculations, and we're going to apply it to this particular question. So after 1 year, this is what our net present value looks like. Our net present value is going to be the benefits minus the costs, and we're going to appropriately discount anything. So for example, you'll notice that the first amount of money in our net present value calculation is that initial cost, that $100. Now, recall that the $100 is experienced at year 0. It's experienced today, if you will, and therefore it's not discounted at all. $100 today is worth $100 today, and so that cost does not get discounted. Now, you notice the $35 that we're going to earn at the end of that first year, or at 1 year, is discounted. It's discounted by the 1 year discount factor. And when we do this, we can see that after 1 year, our HVAC system has a net present value of negative $66. So it hasn't paid itself back just yet. We go to the second year, we add an additional year of positive cash flows for the benefits. And we can see that now the net present value is around negative $35. Again, hasn't paid itself back, But we're seeing that the project is certainly starting to yield benefits. And so we keep doing this, and notice that in each subsequent year, we're discounting the future benefit, the savings of $35, we're discounting it by an additional increasingly discount factor. And this is important, right? The $35 that we get in the third year is a distinct value than the $35 we got after 1 year. And we need to discount those flows appropriately. So we see in the fourth year that the project does pay itself back, and in fact has a net present value of around $24. So the net present value calculation is really important into the cost benefit analysis world. And in fact, that's really all cost benefit analysis usually ends up being, is a net present value calculation or a series of net present value calculations if we're comparing different projects. And so what you would do is you would simply take projects, you would determine some consistency across those in terms of discount rates you're going to look at, time periods you're going to consider, and then you would perform net present value calculations on all of those projects, and whichever one potentially had the highest net present value might be the project that you go with. And so that's really what cost benefit analysis usually is boiled down to. Is just kind of a gussied up, if you will, net present value calculation. However, this is a really important and powerful concept. It's a good way to think about money. It's a good way to think about investment decisions, even if this isn't a high stakes sort of, at your job, you've been asked to compare a particular project. But when you in your personal life are making investment decisions, you're thinking about buying a house, it's often important to think about these types of cost benefit. And you want to make sure that you're doing so in a sound financial way. And net present value is the sound financial way, generally speaking, to perform cost benefit analysis. So just to kind of give a little bit of more beefier understanding of cost benefit analysis, it's usually just a gussied up net present value calculation. That's not to take away from it. It's still useful and important, and can be fairly complicated, but that's not too much, which is actually ends up being one of the benefits of it. Some other metrics that we may consider, benefit to cost ratio. The reason why we might look at benefit to cost ratio is because sometimes in benefit cost analysis, depending upon the discount factor you use or the number of time periods that you look at, projects with really, really high costs can look bad. They can look bad because maybe the payback time period is really long, and anything that's really expensive just kind of a red flag. However, those projects also may have really high benefit to cost ratio. And so if we're willing to incur high costs now, it may yield to greater benefit later on. And so we don't just look at sort of the net present value over a certain number of time periods. We may also look at the benefit to cost ratio over time. And that may help to cause us to not be biased against those high cost projects at the expense of what could be really high benefits. Another really important and well-used metric is what we call internal rate of return. So internal rate of return is just the discount factor that causes the net present value of your cash flows in the future to be zero. The reason why this is important is because this is essentially the return that you're receiving on your particular investment. The investment had an initial cost and again had a cash flow into the future. This is basically the return that you've been getting on that particular investment, sort of above any initial cost that you would have experienced. So it's kind of normalizing the discount factor, and it's giving you this internal rate of return on this particular project. And this is really useful as an additional metric to understanding cost benefit analysis, and is often used in the financial world and the business world to further understand the potential investment opportunities that may arise, and just a little bit of a deeper dive into net present value and cost benefit analysis is used quite a bit. So ultimately, in cost benefit analysis, are we just looking for B greater than C, benefits greater than costs? Are we looking for short payback time periods, or are we interested in high internal rate of return? These are the questions, and cost benefit analysis is one type of analysis that we could perform, and the usefulness of cost benefit analysis is that it's simple, it's straightforward, it gives us a clear picture. But the problem of cost benefit analysis is that it doesn't handle certain things well. First off, it's really easy to manipulate. You can pick discount factors that make projects look good or bad. You can pick time periods that make projects look good or bad. Like, for example, if you have a project that you know is not going to pay itself back over a long time period, and you restrict your time period to a short time period, then you're never that project's never going to look good, because it's always going to be negative. So you can restrict the number of time periods you consider, and you can do the opposite. You can make projects look good. Again, the net present value formula, it's really easy to look at that and realize, picking the discount rate can make a project look better or worse. Picking the time periods can make a project look better or worse. So it's easy to manipulate. It doesn't deal well at all with uncertainty. So anytime there's uncertainty about costs or uncertainty about benefits, cost benefits really becomes diminished in its value, because there's really not a whole lot of way to build that uncertainty. And we could weight relative costs and benefits by our assumed probabilities of those events occurring, but that's really getting into some complicated arenas, and takes us away from the simplicity of cost benefit analysis, but it's a real weakness. And then lastly, cost benefit analysis can't handle implicit value. We see this show up oftentimes whenever the government or some policy agency is thinking about a policy to make some sort of improvement. Maybe we're talking about like environmental cleanup, and the environmental cleanup is very expensive, and the direct human benefits may not be very large. So it doesn't necessarily benefit humans a whole lot, other than it cleans up an environmental amenity, it cleans up an area. And so the cost benefit analysis may ultimately not look very good, when in fact that project may be highly valuable in a more naturalistic sense. It might be valuable to nature, it might be valuable to biodiversity, and also it may be valuable to mental health. The research shown that environmental amenities help people, they keep people happy and things like that. And so a cost benefit analysis is not able to really deal with the implicit values of things, those sort of non-quantifiable values. It can only deal with explicit values. And so that's another weakness. Cost benefit analysis has been criticized, in fact, for being way too focused on the monetary aspects of decisions. And I think it's a fair criticism, although that's the point of cost benefit analysis, is to look solely at the quantifiable and the monetary aspects of these things. So I would say cost benefit does what it does. It does its own thing, and it's extremely useful, and it's simple to explain. It's a good teaching tool. It's often something that is alongside other analysis, so it's usually a component to other analysis. So it has its purpose, and it's useful. It's good skills to have. It's just good. Everyone should understand cost benefit analysis. Everyone should understand time value of money. These are really useful skills to understand in your financial life, in your personal life, in your professional life. And so that's going to be all, and hope you enjoyed the video.